Ever heard traders mention terms like P&L, VWAP, or float, and had no clue what they meant? It's like they're speaking a different language, right? Trading has its own unique lingo, and if you don't understand it, you're walking into a casino blindfolded. In this video, we're breaking down 15 essential trading terms that every single beginner will encounter. Think of this as your crash course in stock market slang so you can start trading with confidence. Let's dive in. Alright, let's kick things off with the most important term on our list. P&L, or profit and loss. This is your report card in the stock market. It tells you exactly how much money you're making or losing with your trades. Knowing your P&L helps you understand if your trading strategies are actually working, or if you need to make some adjustments. No emotional trading here, just cold, hard data. Next up, we've got the bid-ask spread. When you're buying or selling a stock, you'll see two prices, the bid and the ask. The bid is the highest price a buyer is willing to pay, and the ask is the lowest price a seller will accept. The difference between these two prices is the spread. The smaller the spread, the more liquid the stock, meaning it's easier to buy and sell quickly. Now let's talk about leverage. Leverage is like borrowing money from your broker to amplify your trades. It's like having a superpower that lets you control a larger position than what you could with just your own cash. The upside? Your potential profits are multiplied. The downside? Your potential losses are amplified too. Leverage is a powerful tool, but it's like handling dynamite. Use it carefully. Speaking of getting burned, let's talk about margin calls. When you're using leverage and your trades start going against you, your broker might hit you with a margin call. Essentially, they're telling you to deposit more funds to cover your potential losses. If you can't cover the margin call, your broker might start closing out your positions to protect their own interests. Not fun. Now let's dive into a more technical term, VWAP, or volume weighted average price. VWAP is a way of figuring out the average price a stock has traded at throughout the day, taking into account both the price and the volume of shares traded. Traders use VWAP as a benchmark to see if a stock is trading above or below its perceived fair value. If a stock is trading above its VWAP, it might be considered overbought, and if it's below, it might be considered oversold. It's just another tool in your trading arsenal. Alright, let's talk about slippage. Slippage is the difference between the price you wanted to execute your trade at and the price your order actually gets filled at. It can happen in both directions. You might get a worse price when buying or a worse price when selling. The key is to be aware of slippage and try to minimize it as much as possible. It's one of those annoying things that can happen in trading. Now, let's talk about liquidity. Liquidity refers to how easily you can buy or sell an asset without causing a major price swing. The more liquid a stock, the easier it is to get in and out of trades quickly without getting burned. Think of it like a bottle of water in a supermarket, plenty to go around, so the price is stable. The same goes for stocks. Alright, let's talk about circuit breakers. These are like the emergency brakes for the stock market. Circuit breakers are automatic trading halts that kick in when the market drops by a certain percentage. Think of it like a cool-down period for the market to catch its breath and prevent a full-blown panic. They're there to protect everyone from a complete meltdown. Now let's talk about float. This refers to the number of shares of a company's stock that are actually available for trading on the open market. The float represents the shares that you and I, the average investors, can actually buy and sell. A smaller float means there are fewer shares available, which can lead to more volatility. A larger float generally means more stability. Alright, let's talk about breakouts. A breakout happens when a stock's price breaks through a key resistance level with strong volume. Traders watch for breakouts because they often signal a shift in momentum and can lead to significant price moves. It's like the stock is breaking free from its shackles and ready to run. Of course, not all breakouts are created equal. Now let's dive into the world of technical indicators with the RSI, or Relative Strength Index. The RSI is like a thermometer for a stock, measuring its temperature in terms of being overbought or oversold. A reading above 70 usually suggests the stock is overbought, meaning it might be due for a pullback. A reading below 30 suggests it's oversold, meaning it might be primed for a bounce. Traders use the RSI along with other indicators to make more informed trading decisions. Alright, let's talk about scalping. This is a high-speed trading strategy where traders aim to make many small profits from tiny price fluctuations. Scalpers need to have lightning-fast reflexes and nerves of steel because they're getting in and out of trades within seconds or minutes. It's not for the faint of heart, and it requires a deep understanding of market dynamics and order flow. Imagine a hummingbird flitting from flower to flower, quickly sipping nectar. Now let's talk about market depth, also known as the order book. The market depth shows you all the buy and sell orders for a particular stock at different price levels. You can see how much volume is stacked at each price, giving you an idea of the stock's liquidity and potential price direction. It's a valuable tool for traders who want to understand the balance of power between buyers and sellers. It's like looking under the hood of the market. Alright, let's talk about ATR, or Average True Range. This indicator helps us measure how much a stock typically moves up or down in a given period, usually a day. A high ATR means the stock is prone to wild price swings, like a roller coaster. A low ATR means it's relatively stable, like a sailboat on a calm lake. Traders use ATR to set stop-loss orders, determine position sizes, and manage their risk. Finally, let's wrap things up with beta. This measures a stock's volatility compared to the overall market. A beta of 1 means the stock tends to move in line with the market. A beta greater than 1 means it's more volatile than the market, like a sports car. Investors use beta to assess a stock's risk level and diversify their portfolios accordingly. There you have it. 15 essential trading terms that every beginner needs to know. Now you can confidently navigate the stock market waters without feeling like you're lost at sea. Remember, knowledge is power, and in the world of trading, understanding the lingo is half the battle. If you found this video helpful, hit that like button, subscribe to the channel for more stock market insights, and don't forget to ring that notification bell so you never miss an update. Until next time, happy trading.